Welcome to this deep dive into Shaily Engineering Plastics Q3 FY26 results. We're looking at a company in the middle of a massive transformation, where their strategic healthcare pivot has officially taken flight. The growth story here is incredible. Total revenue is up 27% year over year, but the real star is the healthcare segment, which exploded by 139%. This shift to high-margin medical devices has pushed EBITDA margins up by 310 basis points to a solid 26.5%. Looking at the core financials, revenue reached 250.5 crore rupees. However, profit after tax jumped 48% to 37.4 crore, and earnings per share followed suit at 8.13 rupees. The key insight here is that profit is growing nearly twice as fast as revenue, a classic sign of operating leverage kicking in. Shaily is showing true mastery over its margins, moving from 23.4% in Q3 FY25 to 26.5% this year. This was driven by a better healthcare product mix and increased plant utilization. Gross margins have skyrocketed to 58.4%, up 1,090 basis points as they shift from commodity plastics to complex engineering. The primary engine of this growth is the GLP-1 segment. Shaily has become a direct proxy play for the global weight loss boom, with healthcare revenue more than doubling in a single year to reach 104.3 crore rupees. It wasn't all growth, as the consumer segment saw a 13% decline in revenue to 122.8 crore due to soft global demand. However, the pivot point here is critical. The healthcare explosion was so powerful that it completely erased the decline in the legacy business. The industrial segment acts as the silent performer for Shaily. Revenue here grew 87% to 23.4 crore, supported by new mandates in power tools and increased orders for LED lighting. It provides a steady, diversified revenue stream alongside the medical boom. Shaily is thinking global with a massive expansion into Abu Dhabi, UAE. With an investment of 130 to 150 million AED, they are targeting a capacity of 75 million pen injectors per year. This project is expected to be operational by Q4 FY28. The execution is matching their ambition. They've added 2 new customers in the GLP-1 segment and signed 2 new contracts for pen injectors. Most impressively, their return on capital employed, or ROCE, has skyrocketed to 38.4%, with 71% of revenue coming from exports. To lead this medical transformation, Shaily has brought in top-tier global talent. Their new COO of healthcare, Mr. Joe Com, comes with a high pedigree background from industry leader SHL Medical. The balance sheet remains very healthy to fund this growth. The debt-to-equity ratio is a comfortable 0.3x, with total debt stable at roughly 189 crore rupees. With a strengthening net worth of 635.5 crore, they have ample headroom for the Abu Dhabi capex. The market is currently re-rating Shaily from a plastic processor to a medical device player. This narrative shift explains why it trades at a premium 56x PE ratio compared to legacy peers like Time Technoplast at 21x. You're paying for the high margins and the growth runway. No investment is without risk. The risk radar for Shaily includes execution risks regarding the Abu Dhabi project, volatility in polymer input costs, and a high reliance on a few major pharmaceutical companies. Let's look at the checklist. Earnings quality is high and matches utilization, and there is clear capex visibility through FY28. While revenue concentration in healthcare is a factor to watch, the overall thesis is clean with manageable risks. The final verdict is constructive. Shaily has successfully transitioned into a precision medical manufacturer. The tailwinds from the GLP-1 market and high margins justify the premium valuation. If you found this earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.